Hello, friends. Welcome to Nirmal Bang. I'm Piyush Jain, and today we are going to be discussing markets. A lot of things have been happening in the markets over the last 2 months. We have seen corporate earnings. We have also seen different shades of earnings from different sectors. Of late, we have also seen volatility in the markets. Um, Global cues, perhaps from the perspective of interest rate hikes. Also, now inflation perhaps could be increasing because we are seeing sharp increase in energy prices. What could there be an impact for us in from the perspective of inflation or earnings or domestic inflation, perhaps interest rates? Is that something which you should really think about? And there are numerous factors. It's a very complex world, and to really navigate through this complex world, we need the advice. We need the sort of outlook from industry veterans, and who is better than fund managers who actually manage a large corpus. So now, actually, welcome. Uh, I am now going to welcome on the show an industry veteran, the Senior Vice President and Fund Manager Equity of UTI AMC, Mr. Karthik Raj Lakshmanan. So, welcome to the show.
Hi, Piyush.
So, let's first talk about the markets. How are you looking at the markets, the Indian markets in particular, from the perspective of where we are right now, from the perspective of global markets? Of late, we have seen for some time, some months back, global funds were going out. Then we saw sort of started seeing some money coming back. It has been a slightly volatile, but on index wise stable. But it has been quite an eventful sort of year for the markets. What's your own thinking on the markets?
Yeah, markets tend to be eventful most of the times. I mean, there are some events or the other which is catching the attention of the market all the time. Like you mentioned, I mean, last 6 months have been a stellar run for Indian markets, particularly where mid and small caps have outperformed significantly and valuations have stretched. And even large caps have moved up from the March lows, and to that extent the valuations are a little higher. But when we look at it from a long term average, the large caps still seem in line, and they're not really in a very expensive zone. They are higher than the long term average but not too expensive. Compared to that, mid and small caps seem to be on the expensive zone compared to their own trading history. So at this point in time, large caps seem little favorable compared to mid and small caps as far as domestic markets are concerned.
So when I hear from you like that, what would it imply that the sort of monthly SIPs or monthly flows which are coming to the funds, those should be now more deployed in the large caps, or even it is a time when actually you should start lightening up the existing mid cap portfolio?
So the way we look at it is, like I said, I mean, from within the equities, the large caps look little more attractive. Not because I am managing large cap, but from a data perspective as well. That's what is being seen. Now, from a allocation perspective, actually, we've seen the counter that significant amount of money is actually going into mid and small caps. For a long-term investor, still there is definite potential from mid and small cap perspective as well. Just that one needs to bear in mind that mid and small caps come with higher risk. When you look at 5-year rolling returns, the mid cap still can give you better returns, but for that, there is a higher risk component as well. So one needs to understand their own risk, the appetite, and based on that, they will have to go for an allocation, and not necessarily the recent phenomenon. So the starting point may be a little unattractive, but if they have a longer time horizon, still any of the asset classes still make sense. But like I mentioned, from a near-term perspective, obviously the large caps look a little better.
So a couple of my viewers actually would also be thinking like this, and I will ask this question on their behalf. The question will be that the valuation is a concern or a relatively better outlook for large caps is primarily because of a strong run up. So multiple quarters already factored in advance for the mid caps, and that's why the large caps are looking better. Or you perhaps are also thinking that in this macro environment, large caps perhaps in the current context of valuations, large caps actually should be trading better. So is it more about a stable earnings outlook, or it is more about the run up is already in advance?
Yeah, I think the first part more and less of the second part. The first part is, I mean, clearly the valuations. If you see the last 6 months, the mid and small caps have outperformed by probably 15 to 25% compared to the large cap if we take the index. So to that extent, there's been a sharp rally, and the valuations are expensive. So to that extent, the risk reward is a little less favorable. But the second part is also equally true. I mean, large caps come with a little more stability compared to mid and small caps, which is what I mentioned when I said when you
Yes.
look at the risk, the mid and small cap risks are higher. So to that extent, the investor has to measure their risk appetite before jumping in. Yeah.
Let's talk about the June quarter earnings. Were you sort of pleasantly surprised? It was neutral. What was the take on the June quarter earnings?
The June quarter numbers were more or less in line to slightly positive. The number of upgrades, downgrades were more or less equal, and overall level, we've not really seen a major change in the earnings expectation for FY24. So to that extent, it's more or less in line. There are few sectors which did really well, like financials or auto, capital goods. These did well, while some of the sectors like consumer discretionary, IT, they were laggards versus expectations. The trend, if we see in the first quarter, the top line growth was probably in single digit, but the earnings growth were quite strong in double digit. That's because we are coming off a base of high inflation in the last year, June quarter. The commodity prices were very high, and from there, the commodity prices, most of the commodity prices have corrected, and to that extent, there has been a margin expansion that we've seen at the aggregate level. So that's where, while revenue growth has been probably in the single digit, but the profit growth has been quite strong. And even for the full year, the expectations are for a teens kind of earnings growth.
Right, and within this, like which sectors, according to you, were the winners? Where actually you thought that these sectors actually have done really well?
Uh, from a market perspective or from a results
Earnings
perspective?
perspective. Earnings perspective.
Earnings perspective, like I said, autos again, they've seen margin expansion. They had very strong order books, and to that extent, the revenue growth has also been quite healthy. So these are some of the sectors which have really done well. Oil and gas tends to be lumpy, but otherwise, these are some of the sectors which have really done well.
And what's your view now? Like as we are traversing through, and I would say actually we are towards the end of September quarter, and as we move towards the December quarter, we are now actually seeing sharp rise in energy prices. Is that something
True.
which is a sort of cause of worry? Like how you're looking at it from a top view?
So, from India's perspective, clearly we are a net importer of crude, and crude touching $90. That's definitely a cause of concern from a trade deficit perspective. But luckily, we are in a position where, I mean, our services exports have continued to do very well, and to that extent, our current account situation is quite comfortable. So compared to probably 3 months back, it is a little bit of negative, but overall, it is not unmanageable situation that we are in. So to that extent, overall macro perspective, we are still quite comfortable. Definitely, energy prices moving up will lead to a higher trade deficit, and probably will have some impact on inflation, but it is still manageable.
I actually wanted to come to you on IT, pharma, energy because they are also related to the currency. Our
Right.
past observations have sort of told us or have revealed that whenever there is a higher energy price for an extended period of time, that usually is coupled or followed by currency falling down. Because usually
Right.
dollar starts making an impact. And when that
Right.
happens, we start talking about what is going to happen now on the earnings of exporters, service exporters, or manufacturing exporters. So IT pharma naturally comes into the mind. Energy stocks, perhaps those could be the refiners. Again, they benefit because they earn in dollars. So
Right.
apart from that, like couple of other sectors, but these primarily because I was taking a look at your fund list, and I was curious to know your views on IT and pharma stocks, how they're looking to you.
Correct. So IT and pharma, we are overweight. IT, in fact, we went overweight in the start of the year, and the last 6 odd months we've kind of increased exposure. This sector, 2021, the valuations were expensive, and it was building in a very blue sky scenario. And from there, what we've seen is that globally there has been a sharp interest rate hike, and to that extent, there's been a bit of caution in the global economy, and a lot of their clients are the US and European corporates, and to that extent, we've seen a bit of slowdown as well. Many of these companies from that point have seen time correction and absolute price correction as well. So going into 2020 FY24 or early 2023, we found the valuations are attractive, and incrementally a lot of the negative news is already factored in. From a longer term perspective, if we see these are companies with very good corporate governance, very healthy cash flows, and still a long runway for growth led by digital transformation and the cloud opportunity. Uh, so to that extent, we've been increasing exposure to IT because the valuations have turned attractive from the previous high levels. And coming to pharma, again, this sector, even from a longer term perspective, has underperformed, and hence the valuations also are quite comfortable. But if we look at it, the domestic piece, the domestic focused companies, they have metrics which are comparable to consumers. They have probably high single digit to double digit kind of growth, and very healthy on profitability. And if we look at the generics business, there what we've seen is there has been a little bit of benign, I may not say benign, but improvement as far as the pricing erosion situation is concerned in US. And to that extent, the earnings have been reasonably strong in the first quarter for pharma companies as well. There also we are kind of positive, but we are quite selective. I mean, we like the domestic pharma piece, and even within the exports, the specialty pharma, where the pricing discipline is far better, is what we like, and those are the spaces where we are overweight on. And
Nirmal,
coming to the question,
sure,
just to
please
complete,
continue.
yeah,
Please continue.
just to complete, this is not necessarily just based on a view on the rupee dollar. These are more structural plays, and not necessarily taking a call on rupee dollar. That could still, like I said, I mean, the situation may be better this time around because of probably the services export lending a helping hand, and maybe we don't see that kind of correction. It is more from a risk reward perspective. One, the valuations are comfortable, and two, the outlook also seems decent. And to that extent, we are overweight IT, and even pharma to a small extent.
Right, sir. And I'm curious to also ask you that is hospital something like you're not overweight in hospitals or you're not fond of hospitals?
So from a large cap perspective, the opportunities are limited, and to that extent, I don't have exposure on hospitals as such. But we have some exposure to diagnostics, where the return ratios are quite healthy, and again, the runway for growth is quite strong. We've seen some amount of competitive intensity increase in the last year or so, but last couple of years. But we hope that eventually the stronger companies emerge as winners, and compounding continues.
Are you happy with the recent round of price hikes by the online players in the diagnostic space? Because it normally works in favor of offline diagnostics.
Clearly, I mean, we've seen, I mean, the height of competition was probably a year back. From there, we've been seeing that some of these new age players also taking price hike, and to that extent, the situation seems better. And anyways, the opportunity for growth is quite strong. I mean, the unorganized is still a large part, and the organized has room to gain share from the unorganized.
And in IT also, sir, like, is there any particular theme where you're focusing, or is the traditional top five as favorites, and within them, you're focusing on top two, three, four? Like, what's the any particular subsector which you're liking?
So, our being a large cap fund, predominantly the focus is a lot more on the large companies, the not necessarily by market cap. They are, some of them may be large cap, but still from a nature they are mid-size. So we do have some exposure to mid-size companies, but predominantly it is more in the large companies, the top five, top six companies where we would have exposure, because we believe the top companies have advantage in terms of scale, and they can continue to grow even on this scale. So to that extent, we are overweight on some of these large companies as well.
Right. Our viewers, actually, you can take a look at the details of the holdings of the funds of Mr. Karthik Raj. I think all the discussions basically would be pretty much evident on those funds. But let's move forward towards the retail sector. I know I won't ask you on stocks, but for our viewers, a couple of stocks figured out in those lists: Tima, Trend, and there are a couple of stocks actually, which was evident to me that there's a liking for branded discretionary consumption. So coming to the theme, sir, uh, are, are you in favor that perhaps branded discretionary consumption in various formats, is that something where actually you see a sort of a good long-term earnings growth?
Yeah, so retail, if we see clearly, there is a potential again for market share gain for the organized to from the unorganized, and that is something which is likely to continue probably for the next 5-10 years plus. And to that extent, the runway for growth for many of these companies is quite high. And again, in durables, the penetration is quite low, and there again we see as the middle income population keeps growing, the affordability factor comes into play, and they could have strong volume growth for a longer period of time. So overall, consumer discretionary, that is retails plus consumer durables, and to some extent even auto, if we add, we believe there is a structural story, and to that extent we are positive on that. So if we compare consumer, say the retail and durables versus consumer staples, both are expensive, but from a runway for growth, we believe the retail and durables have a higher probability to grow faster compared to the many of the staple companies because of the penetration levels. So that's where our preference is for some of these retail and discretionary companies. This, as we are discussing about MasterShare, which is a large cap fund, so where we have more overweight on these discretionary names and underweight on the staple names, because of the growth differential that we see from a longer term perspective.
Of course. And what's your view right now? Because there was a particular time where everybody was viewing MNC stocks with a much higher alpha due to dividends or any other stories. But you also have MNC Fund. You manage that. Help us understand from the perspective of MNC sector what you like in that, and how's the current sort of outlook looking there?
Yeah, so again, MNC companies, the advantage is most of these companies have strong cash flows and healthy return ratios. So to that extent, these are companies which are high on quality, and most of them very good disclosures and corporate governance. And to that extent, these companies are kind of little lower on the risk parameter, if you see. And MNC as a theme, you have a diversification as far as sectors are concerned. So you have autos, you have healthcare, IT, even financials, capital goods. So it's a very well diversified FMCG. So it's well diversified, though it is a thematic, and to that extent, it provides diversification. At the same time, it provides exposure to some of these companies with very healthy return ratios and cash flow generation. Um, so that we believe from a longer term perspective, people who are looking for these qualities where they focus a lot more on high quality businesses, there is an opportunity to participate in those. That's how we look at it. It's more from a longer term perspective. Someone wanting to participate in these this theme, it makes sense.
Sure, sir. Last question. With that, actually, we'll close. I will reach towards the end of this conversation, and that would be we've talked about the current quarter, sectors, the markets, but nothing better than as a question to really ask you how is overall FY24 looking to you from the perspective where we started from in April. Now we are almost 6 months down the line. Is the optimism continuing? Like what has changed since April to September? And how actually you're feeling about as we close towards March 2024 for the markets
So from
and
the,
earnings?
so yeah, so we don't really go about predicting a market from a short-term perspective at UTI. So generally, our view is we tend to give out at the start of the year kind of measure as to whether equities, how attractive equities is, what is the macro situation like. So at the start of the year as well, when we compared equities with fixed income, we said probably equities is slightly expensive, and
Okay.
post that actually the markets have actually run up further, so that still remains.
So
But
does it imply that now equities are looking more expensive to you versus debt?
Yeah, versus fixed income, definitely yes.
Okay.
But is it very, like I said at the beginning of the conversation, like I said, is it obnoxiously expensive that we should be completely defocusing from equity? That's definitely not the case. It's slightly higher than the long term average. So to that extent, it really doesn't matter, or I mean, it's not definitely in the very expensive zone. It's still comfortable, just it's a little tad higher than the long term average if we take large caps as a category. Mid and small caps may be a little more expensive, but overall, that is where we started, and from there we've seen a little bit of rally. From the economy perspective, what has happened is, like, I mean, from a monsoon perspective, it's been a deficit so far. We are in high single digit to double digit kind of deficit, and to that extent, maybe the agri economy and rural economy, we need to see how it kind of picks up. So that is one thing to watch out for. And the other thing, like I said, the earnings growth in first quarter has anyways been healthy because of a benign base. But for the full year, it is expected to be around high teens. Could there be a couple of percentage cut there? Possibly yes, but still double digit mid-teen kind of number is still quite healthy. So to that extent, the earnings growth is likely to be healthy. Just that a part of that is already in the price, and to that extent, maybe we need to be little more cautious, especially in the mid and small caps. But from a longer term perspective, if we take next 5 years or 10 years, the potential
The
for
story is
India to
good.
be, yeah, the
Absolutely.
potential for, yeah, because I'm sure, I mean, many leaders have already called out India's decade and India's century. But just to reiterate the point, probably we would be amongst the fastest growing economies, even if we do a 6%, which is what we've done in the last 20 years, real GDP growth. And on a nominal basis, if we have a double digit kind of earnings growth, that is good. And to that extent, we have a good opportunity. So for a long term investor, still there's a lot of hope. But from a near term perspective, we may be slightly expensive.
Absolutely, sir. So I think those are the words of wisdom coming from our veteran industry fund manager. But the last word is the most important. Long term, a young population, growing population, growing wealth, growing middle class, a stock market which is going to still have many, many IPOs being added, many, many companies worth investing. And this story perhaps is going to continue and think, and we will keep talking. To Mr. Karthik Raj again and again and keep asking him basically about the markets. But, sir, thanks a lot for coming on our show and telling us all about the market sectors and the earnings.
Thank you. Thanks a lot for having me on your show. Thank you.
And dear viewers, hope you enjoyed the conversation and you also basically had all the insights about the markets. For now, it's a wrap for this conversation.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.